Hi friends, good morning everyone. Welcome to my channel. Today our topic is conventions of accounting. Conventions are the rules and principles for preparing your accounts. Okay. Is there anything more? Yes. These rules, these principles are mainly focused on the preparation and presentation of your financial statements, that is trading P&L and balance sheet. These conventions give your financial statements a clear picture. These conventions say how to prepare your financial statements, what to include in your financial statements, in what way to present your financial statements. Okay, let us see the conventions. The first convention is convention of full disclosure. What this convention say? This says you have to disclose all significant information in your financial statements. You have to prepare your financial statements and you have to present your financial information in a proper way with proper classification, that is classification of various items under various heads, and explanations to financial information wherever necessary, because there are so many users who are going to use your financial statements. For example, shareholders, bankers, rating agencies, income tax authorities, and so many other persons. The second convention is convention of materiality. This is very interesting. This says you need to disclose all the significant financial information. This means you need to consider all the significant information which has an economic effect on your business information. You have to consider all the material things and you can leave the things which are insignificant or immaterial. This doesn't mean to leave all other information and presenting only those transactions with 4 digits or 5 digits. This doesn't mean that. This means stationery expenses, expenses related to snacks and tea, expenses related to any printing, all these things. What is a material thing and what is not material is purely dependent on the circumstance of the case, and moreover it is the discretion of the accountant. For example, 5,000 rupees may be a significant thing, may be a material thing to a small business, but it may not be a significant amount, it may not be a material amount to a huge firm. This materiality concept says we have to consider all significant financial information in your financial reports. This is a contradiction to the convention of full disclosure. Here material item means which has a huge impact on your financial data. Material thing means a significant thing that affects your profit or loss figures, or those items which affects the decision making of the users of financial information. Insignificant things can be left out or they can be merged with other items, but significant items needs to be disclosed in a visible manner. What this convention of materiality say is, if anything just increases the work of an accountant but elimination of that won't affect the decision making of users of financial statements, then he can leave those things. This is a contradiction to convention of full disclosure. The next one is convention of consistency. What this consistency says: use one method of accounting My dear friend, while valuing your stock, use either FIFO, either LIFO or weighted average. Choose one thing which suits your business the best. Similarly, for depreciation, choose either straight line method or WDV, which suits you the best. But don't change your methods year after year. You have to follow the same methods of accounting in the next years also. This helps in comparison of financial statements of different years. For this analysis, you need to follow the methods in a consistent manner. The next one is convention of conservatism. What this convention of conservatism say? This convention say anticipate no profit but provide for all possible risks. If there is a possibility of a gain, until it is realized, unless you are legally entitled to receive that gain, don't recognize that. But if there is a possibility of getting a loss, immediately consider that in your accounts. This means no doubtful income is considered in preparation of accounts, but any doubtful expenditure or any doubtful loss needs to be considered while preparing our accounts. This is about convention of conservatism. And moreover, a small point, valuation of closing stock is based on this principle of conservatism. This says closing stock needs to be valued at cost or market price, whichever is lower. The cost is 5 lakh rupees, but the market value is 4 lakh rupees. Tomorrow, if you sell your closing stock, how much amount will you get? Only 4 lakh rupees. Then there is a loss of 1 lakh rupee. So we need to recognize that loss and we need to write the value of closing stock as 4 lakh rupees, not 5 lakh rupees. It means the value of closing stock is following the principle of conservatism. It is recorded as the cost price or market price, whichever is lower. This closing stock valuation is a contradiction to the cost concept. If you remember the concepts of accounting, in that what the cost concept says, any asset needs to be considered at cost price. Now, closing stock is also an asset, yes, but you are valuing at cost price? No, I am valuing the closing stock at cost or market price, whichever is lower. Here there is a break to that cost concept. If you want to look at concepts of accounting, I am leaving the link. You can go there to watch it. Hope you understood. If there are any doubts or any comments, leave it in the comment section. If you like the video, give a like, share the video, and don't forget to subscribe. If you hit the bell icon, you will get notified whenever I publish a new video. This is for today. Thank you for watching. Let's meet in the next video. Till then, bye.